and welcome to Sectors Up Close. I'm Emma McCarthy. Our focus today is on the impact of inflation on the consumer staples sector. And here to discuss it with me is Mike Hanson, Senior Vice President of Research at Fisher Investments. Slow and steady wins the race? Well, not quite for this defensive sector. When compared with the S&P 500, consumer staples has underperformed over the past 1, 2, 5, 10 and 20 years. This is despite the pandemic, which kept people at home, stocking up on basics including food, alcohol and tobacco. One headwind facing the sector is inflation. Margins for some businesses are tight, and now they face rising costs for labour amid supply chain shortages. But should investors stay clear of this sector, considering it has a market cap of $2.6 trillion in the US alone? Let's break it down with Fisher Investments' Mike Hanson. Mike, thank you for joining me. First of all, is inflation really a worry for a sector that one would assume can just pass costs on? After all, everyone will continue to buy coffee at pretty much any price, won't they?
Yes, Emer, I think you're exactly right to say that. And I think the right way to start this discussion about consumer staples is about inflation, because for all the talk of it, and inflation has been high. Input costs are much higher this year than they were just a year ago. But inflation is moderating. And I think the way that investors should be looking about inflation right now is on a month-over-month basis, not on a year-over-year basis. When looked at that way, the U.S. CPI has in fact been slowing from a very hot rate in the summer all the way down now to levels that are just about in line with their long-term average, going all the way back to the 40s in the last several months. I expect that to continue, but I do expect input costs to continue to be elevated. And consumer staples are a defensive category. And you said that they've, underperformed for quite a long time. That's exactly right, because a lot of the last 20 years, in fact, have been bull markets. It's about non-cyclical demand. It's just as you say, it's about things like coffee, consumer products, personal care. That means they see consistent demand over time, which gives them defensive characteristics. They tend to do better in a bear market. But it means when they see rising input costs, they don't really have the power to raise those prices very much because they'll sacrifice volumes. You have rising meat costs, grains, oils, labor costs, and of course transportation. All of that will eat into margins of consumer staples firms today.
And Mike, how does consumer staples compare with the other big consumer-related sector, consumer discretionary, which includes things like iPhones and cars?
Yes, it's a very different category. And what it's all about is, whereas staples are more like defensive and non-cyclical, discretionary is exactly the opposite. It's about that extra dollar a consumer has to spend, and therefore it's quite cyclical. But what's interesting is that this category has been changing over time. Used to be very sensitive to inflation at a time when automobiles, in fact, were one of the largest components of consumer discretionary going back decades ago. That's not true anymore. What you have now is a lot of e-commerce companies and especially luxury goods. And the nice part about that is they've got strong brands and they have pricing power. You contrast that to autos, which are not only in highly competitive markets, but as we've known and seen for the last really several months, if not the full year, they're seeing semiconductor shortages and input costs of all kinds, and they don't have the pricing power because they're in a very competitive atmosphere as well.
Mike, not everyone is down on consumer staples. Warren Buffett's Berkshire Hathaway holds 9% of Coca-Cola. What would you recommend investors do?
I think you're exactly right. I think there's some reason for optimism, but we need to be careful. Margins in general for firms in the third quarter have actually been pretty strong. And for the S&P 500, profit margins are at or near their all-time highs, in fact. And if you break out consumer staples and consumer discretionary, they're both sitting at around 7%, which is right around their 5-year average. So these numbers are actually pretty good. Firms are proving resilient. What I would say, though, is that neither historically staples nor discretionary stocks tend to outperform during rising inflation. So if you think inflation is going to continue to be hot, where you really want to be is places like energy, materials, industrials, and it's about a coin flip whether categories like technology outperform in high inflation. Prices are up, delays are going to continue to exist, but I think that firms with great pricing power, big gross profit margins, and the ability to pass those costs on can do better. Some companies will, some companies won't. Companies like Coca-Cola do have strong brands, but they also have very high competition, so you want to be careful there. I think inflation is going to moderate over the next year, mitigating many of these impacts. And where we really are is something more like a late cycle environment for stocks, which favors that growth category. And growth has really outperformed for most of the second half of this year. They have that in consumer discretionary. Look for those companies with big growth prospects that have big gross margins and, in fact, do have that pricing power to push prices through.
Mike, thank you. That was Mike Hanson, Senior Vice President of Fisher Investments. Well, before I go, here are some of the top stories in this space. Kellogg warned on Tuesday its full-year earnings could take a hit due to a strike at its cereal factories. The company said on Wednesday its cereal plant workers union had rejected a revised offer. Kellogg said full-year adjusted profit growth could be at the low end of its range of 1% to 2% due to labour challenges and supply issues. British supermarket Sainsbury's says it's well placed for Christmas as it reported a 23% jump in first half profits on higher grocery sales. Retailers such as Sainsbury's have been grappling with supply chain issues compounded by a shortage of truck drivers needed to get goods from the warehouse to the store. They're also struggling to maintain sales volumes boosted by pandemic-related lockdowns. And finally, these robots could have profound implications for the demand for labour in the retail industry. Thousands of them swarm across a grid that spans the size of 6 football pitches. Far from a startup, these are made by Ocado, a British online supermarket now worth $18 billion. It's recently announced deals to supply this technology to supermarkets in Japan, France and the US, where it's partnering with Kroger. And that is your roundup of the consumer staples sector. I'm Emma McCarthy and this is Reuters.